Here's another question for everybody here. We're talking about REITs. So which of the following statements regarding a REIT here is accurate? REITs are something that are testable on the exam. Most importantly here, we'll talk about is, what does a REIT need? How does it qualify for favorable tax treatment? Well, for REITs, the most important thing here to remember is that REITs are publicly traded. They pass through income, but they don't pass through losses to investors. What's the investment company that passes through both income and the losses to investors? What's the investment that passes through both? That's going to be a DPP, exactly. So think hedge funds, DPP. That's passing through both income and losses. REITs only pass through income. And please type this into the questions pane. What is the criteria that a REIT has to meet in order to be able to pass through that income? And I'm looking for a certain set of numbers here, certain set of percentages. So I'm looking for exactly 75, 75, 90. I'm looking for that 75, 75, 90. So if you have a REIT, and a REIT has to have 75% of its income in real estate, it also has to have 75% of its assets in real estate, and 90% of the income has to be distributed to shareholders. And if you have all three of those characteristics, right, you don't pay any corporate income tax, it's passed through to the investors, and they just pay their ordinary income tax there. Shareholders are taxed directly. Right, so DPPs, just wanted to reiterate, DPPs, they're not investment companies. DPPs are an alternative structured product. DPPs are an alternative. They're not considered investment companies. They're an alternative. DPPs are the ones here that, yes, April, a hedge fund is a good example of a direct participation program, a DPP. The way that I like to think about it is it's almost like you're directly participating in the actual business itself. Whether you are a limited partner or a general partner of a hedge fund, you're being exposed to that business, its income, its losses. Your risks to it are limited based on if you're an LP or a GP, but that's just what you have to know at a high level. Abina, you have a good question here. So Abina asks, so for everybody's sake, why would an investor want to offset their passive gains? So what does it mean to offset a gain, and wouldn't you only want to offset a loss? That's a good question. And Tom already answered that. Tom is quick as lightning here, beat me to it. That's to reduce their taxes. So that's basically to lower taxes. So if you have a big gain, say you don't want to pay taxes on that, you'll find a loss to help cover that. In fact, by the way, if any of you have brokerage accounts, or if any of you trade stocks, you can write off some of your, or you can reduce the taxes that you will pay on gains on the sale of any of your stocks by taking a couple losses on any other investments that you have. That's a good way that I like to think about it. If I'm invested in a stock, and let's say, I make a decent amount of money, a gain off of Apple, but maybe I went and I bought GameStop stock when it was $400 and now it's trading at 100. Well, I can offset those gains. I can offset those gains by taking that loss, and that will help reduce the taxes that I pay at the end of the year. Same thing for DPPs.